Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Wayne Ferbert, co-founder of Alpha DNA Investment Management. Wayne, it's great to have you with us. Welcome to Trade Talks.
Sure, thanks for having me, Jill. Happy to be here.
All right, you got it. Now tell us about your new ETF and what makes it different.
Yeah, the ticker symbol is SENT. That's SENT. It's the Advisor Shares Alpha DNA Equity Sentiment ETF. That's a handful when I say it out loud, but it is basically, it's a hedged equity ETF. We have this equity portfolio that's very unique. It's very different in how we've built it. And then we build hedges into the portfolio. The goal is to create enough excess return from that equity portfolio to pay for the hedge. And what really makes that equity portfolio different for us is it's using machine learning and alternative data to find hidden demand, right? To find companies that are producing more revenue and EPS than Wall Street currently expects. So once Wall Street figures that out, those companies will be rewarded mostly in their stock price.
Now that's interesting that you have that unique insight because earnings season is around the corner. So tell us a little bit more about that.
Yeah, so like I said, the objective function is let's find the companies that are going to outperform on revenue or EPS, right? And therefore, and by outperform, we mean in comparison to the Wall Street expectations, right? All these companies, we track nearly the entire Russell 3000. So you've got all these companies that have analyst expectations, and we basically are examining this digital footprint, all of that interaction between customers and the actual digital brands of the companies to find traffic. And then where those traffic patterns imply a certain growth that's higher than Wall Street's expectations, that's the companies we want to buy. And that's what we put in the ETF. And since the ETF is transparent, you can go look in the ETF and see at any time the kind of companies that we like that are going to outperform.
So Wayne, how is the portfolio positioned right now, given that the thick of earnings are right around the corner, especially over the next couple of weeks?
Yeah, so the portfolio right now, the portfolio is always going to be a little bit more positioned towards growth. And the reason being is the companies that we're trying to really build a portfolio that has the most companies possible that are going to exceed expectations. And so companies that are going to say grow at 9% when Wall Street's expecting 4%. So examples of companies that we're in that are going to announce earnings this week, right? Nasdaq's going to announce tomorrow, right? And it's in our portfolio. And so we actually, ironically, right, your company, right, we actually believe that your own firm is going to outperform tomorrow. We're bullish on Nasdaq. We own it in ETF. Chipotle tomorrow as well is in our ETF. We're bullish on Chipotle. We believe that they're going to exceed Wall Street's current expectations. Also Intel, right? There's a fair amount of technology positioning. As I told you, growth is going to be what we lean into. So there's a fair amount of technology positioning in our portfolio. Intel is in there. There are a few other chip companies as well. Marine Max. And then if you actually digged into our portfolio, you'd see there's not a lot of energy, but we are bullish on the energy sector in the aggregates. You won't see a lot of energy in our portfolio right now, but there's definitely some. We recently exited Halliburton. But on in terms of other sort of, you'll see in our portfolio right now, there are definitely some retail names. There are definitely some restaurant names that definitely that we like. We've had a really good run with Boot Barn, and Williams & Sonoma is by far the best performer in our portfolio. And even post-COVID, they've continued to have a great run as more and more people improve their homes, right? And spend more time.
Oh, I know. I'm in the process of moving, so I've helped contribute to the bottom line of many of your consumer stocks, Wayne. So to wrap up here, which sectors does your research indicate that are positioned to generate the largest surprises in the upcoming earnings season?
Yeah, so I'll definitely hit on a couple that we just mentioned, right? So in the aggregate, we really think energy is going to do pretty well. We don't own a lot of energy, and the reason why is, remember, if an energy, we're going to lean into growth. If an energy stock does well, right, in terms of outperform expectations, you're talking about maybe they delivered 4% growth when Wall Street was expecting 2 or 3%. That's not as good a buying opportunity for us as a company, maybe in technology, that's going to grow by 9% when Wall Street was expecting 4%. Right? So, but in general, energy is a good sector. If people like that sector, I'd say now is a good time to be playing it based on our view. Technology continues to be good. Retail, trade, and those three are the three I'd say, and you're going to feel pretty good at. A couple you may want to steer away from, industrial services or industrials, communications and utilities, we don't think are going to have a real standout quarter.
All right, Wayne, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.